Today, we're really digging into the U.S. financial markets, specifically looking at where things stand right now, May 7th, 2025. We're cutting through all the noise.
Exactly. We've gone through the key reports, the analysis, trying to give you the bottom line on what's actually happening and, importantly, what it means for, well, for you and your money.
Yeah, think of it as your quick guide to getting up to speed. We've got 5 big stories on tap today. There's the Fed's latest move, or lack thereof, on interest rates.
Then there's Disney, quite the earnings surprise there.
Right. And U.S.-China trade talks, they seem to be back on again.
Yep. And a really interesting divergence we're seeing between Bitcoin and gold.
Definitely want to unpack that one. And finally, something maybe a bit more down-to-earth, those high-yield savings accounts. Pretty attractive numbers right now.
For sure. So let's jump in. The Fed decision first.
Let's do it. So the Federal Reserve met, and they decided to hold the federal funds rate steady, still at 5.25%.
That's the headline. And the thinking behind it seems to be, well, inflation's still a little bit above where they want it. That 2% target, it's sticky.
Right. Not quite there yet.
But they're also seeing other things. The job market seems to be cooling off a bit, maybe less overheating, and consumer spending looks a little softer too. So it's a balancing act.
Okay, so for people listening, rates staying put at 5.25. What does that mean day to day?
Well, if you've got debt with a variable rate, think credit cards mainly, those higher interest costs aren't going away anytime soon. You'll keep feeling that squeeze.
So no immediate relief on that front.
No. And it probably means things like buying a home or making other big purchases that need financing. They stay relatively expensive. It puts a damper on that kind of spending.
And what about for investors? Stock market implications.
You know, initially, stability can be good for the market. It takes away some uncertainty about borrowing costs for companies. So maybe a slight positive reaction there, or at least not negative.
There's a but, isn't there?
There usually is. If these rates stay high for a really long time, it could start to pinch company profits down the road. That might lead to some market pullbacks later on. So it's stability now, but potential pressure building, maybe.
Interesting. Okay, let's pivot to something that sounds, well, a bit more upbeat. Disney. Their earnings report really surprised Wall Street. Stock jumped, what, 10%?
Yeah, a really strong reaction. It seems they beat expectations pretty handily. And the main reasons were better than expected growth in their streaming subscribers, Disney Plus, Hulu, etc., and also really strong attendance at their theme parks.
People are still going to the parks then, despite everything.
Apparently so. People seem to still be prioritizing those experiences, those vacations.
Why is Disney such a big deal beyond just, movies and theme parks?
Well, it's often seen as a kind of bellwether for consumer spending, for general economic sentiment. If people feel secure enough to spend on park tickets, on streaming services, it suggests a certain level of confidence.
So it's a sign people are still willing to spend on discretionary things, fun stuff.
Exactly. That resilience in Disney's numbers might suggest that consumers are still willing to open their wallets for experiences, even if maybe they're cutting back elsewhere. It's encouraging for, say, media stocks, travel stocks.
Okay. But maybe some caution is needed.
Oh, absolutely. I mean, the streaming market is incredibly competitive, right? And if the economy does take a sharper downturn, that discretionary spending could dry up fast. So good news for now, but we need to watch if it lasts.
Got it. Okay. Let's shift from entertainment to global politics and economics. U.S.-China trade talks. Sounds like they're talking again after a bit of a quiet spell.
Yes. Reports indicate that negotiations have resumed. It's a pretty significant development because dialogue had been quite limited for months.
And what are they actually talking about? Any specifics leaking out?
The key topics seem to be the usual suspects, really. Tariffs, especially on things like semiconductors, intellectual property rights, that's always a big one, and market access for Chinese tech companies in the U.S.
Why should the average person, maybe an investor, care about these high-level talks?
Because they have huge ripple effects. Think about supply chains. So many products rely on parts moving between the U.S. and China. It impacts inflation, potentially. Tech stock valuations are very sensitive to this, even things like agricultural exports.
So progress could be good for the market, setbacks could be bad.
Pretty much. You could see some significant market swings depending on how these talks go, or even just based on headlines about the talks.
Any particular companies or sectors to watch closely then?
Definitely companies with big international footprints and complex supply chains. You know, the Apples, the Teslas, maybe chip makers like Intel. Good news could give them a boost. Bad news could be a drag. And maybe keep an eye on ETFs focused on, say, emerging markets or global trade.
Okay, that makes sense. Now, this next one is really intriguing. Bitcoin versus gold. Bitcoin's pushing towards $100,000, you said, while gold is kind of pulling back.
Yeah, it's a fascinating split. Bitcoin was nearing, I think, $97,000 last check, a big jump in just 24 hours. Gold, meanwhile, was down slightly, continuing a slide from its highs back in March.
And traditionally, people looked at both as like safe havens, right?
Yeah.
Stores of value.
Exactly, especially when there are worries about inflation or maybe distrust in traditional financial systems or central banks. They're alternatives.
So the fact they're going in opposite directions,
Yeah.
that's telling us something.
I think it could be, yeah. It might suggest a sort of generational shift, maybe, how different investors think about safe money or alternative assets. Perhaps younger investors see Bitcoin as the modern digital gold.
Interesting. Digital gold.
Its limited supply, its decentralized nature, it appeals to a different crowd, perhaps, than traditional gold buyers.
So if you're thinking about your own investments, how do you approach this? Bitcoin's potential is huge, but it's also volatile.
Extremely volatile. That's the key thing to remember. And the regulatory picture is still evolving, which adds another layer of risk. So, yes, potential for big gains, but also big losses.
So maybe not for everyone.
Probably not. For investors who are more cautious, gold, or maybe things like TPS, Treasury, inflation-protected securities, might still feel like safer hedges against uncertainty.
But for someone with a higher risk tolerance,
For them, maybe a small allocation to crypto, perhaps like 1 to 5% of a portfolio, could make sense. Especially if they're already comfortable with tech and growth investing, it adds potential upside, but you have to understand the risks and be prepared for those swings. Don't bet the farm on it, you know?
right, absolutely. Okay, finally, let's talk cash. High-yield savings accounts, you mentioned rates around 5% APY. That sounds pretty good for just savings.
It's really good. I mean, 5% annual yield on a safe, accessible savings account. We haven't seen rates like that in, gosh, over 15 years. It's a significant difference compared to the, tiny fractions of a percent you often get at big traditional banks.
So this is a real opportunity for people just holding cash. Emergency funds, short-term goals.
Absolutely. If you've got cash sitting in an account earning next to nothing, moving it to one of these high-yield online accounts is pretty much a no-brainer to improve your return without taking on market risk.
Easy win, potentially?
Yeah, a relatively easy win for that part of your money. The caveat, though, is that these rates are high because the Fed's rates are high. If the Fed does start cutting rates later this year or next year,
These savings rates will likely drop too.
almost certainly yes, they'll follow the Fed down. And of course, it's important to remember this is for savings, for short-term needs. It's not a replacement for long-term investing for goals like retirement.
Good point. Okay, so those are the 5 big stories. Stepping back a bit, what are the bigger themes you're seeing in the market as we head into the middle of 2025?
Well, I think there are 3 main things to keep an eye on. First, corporate earnings resilience. We're going to be watching the Q2 earnings reports very closely. Can companies keep performing well even with these higher interest rates and maybe slower consumer spending?
So earnings season will be critical.
Very critical. Big beats could push stocks higher. Big misses could really hurt them. Second theme is this whole soft landing idea for the economy.
Right, the Fed trying to cool inflation without causing a recession. How's that looking?
It's mixed. We see unemployment ticking up just slightly, but GDP growth is still positive. It's a tricky balance. If the Fed manages to stick this landing, you could see a pretty decent market rally later in the year. But if things tip too far one way or the other,
Uncertainty remains. And the third theme?
it's still technology leadership. Tech, particularly AI, cloud computing, cybersecurity, those areas are still driving a lot of the market gains. Companies like NVIDIA, Microsoft, Alphabet are huge players.
Those valuations are high there, right?
Very high in many cases. So while the momentum is strong, those companies need to keep delivering really strong innovation and earnings growth to justify those prices. There's not a lot of room for error.
Okay, so given all that, the Fed, Disney, trade, Bitcoin, savings rates, these broader themes, what does this mean practically for people's personal finances right now?
Well, a few things come to mind. First, if you have variable rate debt, like those credit cards we mentioned, now is a really smart time to look hard at that. Can you consolidate, refinance somehow, anything to reduce that high interest cost?
Get ahead of it if you can.
Exactly. And related to that, with savings accounts actually paying decent interest now, it makes delaying big purchases and saving up for them rather than putting them on a high interest card even more attractive financially.
Makes sense. What about investments?
Diversification is key. It always is, but especially when things feel a bit uncertain. Don't put all your eggs in one basket, whether that's tech or crypto or anything else. Think about a good mix, maybe large U.S. companies, some smaller ones, some international stocks, maybe even some more defensive sectors like healthcare or utilities, depending on your risk tolerance.
Spreading the risk around.
Precisely. And for people who are maybe closer to retirement or just prefer lower risk, this environment actually offers some decent, safe income opportunities now. Those high-yield savings we talked about, also money market funds, even short-term treasury bills are offering meaningful returns. It's a chance to get some yield without taking on big market swings.
Okay, prediction time. Always tricky, I know, but looking ahead, say, the next 6 months or so,
Yeah.
what's your general outlook?
Ah, yes, the crystal ball question. Well, short term, say the next 3 months, I'd expect continued choppiness. Market volatility, those U.S.-China trade talks, upcoming inflation reports that could easily swing things day to day.
So bumpy ride ahead, potentially.
I think so. Tech, especially AI and cloud, will probably stay relatively strong, but maybe prone to some profit-taking dips. And consumer discretionary stocks might feel some pressure if inflation stays sticky or if unemployment worries grow.
Okay, and then looking a bit further out, maybe towards the end of the year, 6 months.
Medium term, so maybe looking out to the fall, there's a possibility if inflation shows clear signs of cooling that the Fed might start to pivot, maybe signal or even begin lowering rates.
And that would be good for markets.
Generally, yes. Lower rates tend to boost both stocks and bonds. So if that happens, combined with current momentum and earnings expectations, maybe you could see the S&P 500 heading towards, let's say, a range of 5,350 to 5,500 by November-ish. It's plausible.
And Bitcoin testing $100.
It's definitely in the realm of possibility, especially if the current hype cycle and maybe more institutional money comes in. But again, expect massive volatility with crypto. That $100 K test could come with some sharp pullbacks too. It won't be a straight line up.
Understood. Okay, so just to wrap things up quickly, we've hit the Fed holding steady, Disney's strong showing, the restart of U.S.-China talks, that fascinating Bitcoin-gold split, and the opportunity in high-yield savings, plus those key themes. Earnings, the soft landing watch, and tech's continued dominance.
Yeah, and the main message for you listening is really that things are complex, they're dynamic. Staying informed, being thoughtful about your own financial strategy, whether it's debt, savings, or investments, is just crucial right now.
Absolutely. And maybe a final thought to leave everyone with. Consider that Bitcoin and gold divergence again. What does it really tell us about how we and maybe the next generation think about safety and value in an increasingly digital world? Something to chew on. Thanks for diving deep with us today.